Good evening. I'm Alex Triantis, Dean of the Johns Hopkins Carey Business School. It's my pleasure to welcome you to the Carey Business School Distinguished Speaker Series. In this series, we invite the most accomplished business professionals to discuss today's most compelling business challenges. I'm very pleased that our distinguished guest today is Chris Schaper. Chris is a Group CEO for AIG RE, the global reinsurance business of American International Group, AIG. Chris is responsible for the implementation and execution of AIG's global assumed reinsurance strategy with a focus on the development of innovative reinsurance and capital market solutions. He's also responsible for the firm's applied research enterprise, which is highly engaged in risk analytics associated with natural catastrophes and environmental and climate change issues. Chris has more than 30 years of experience in the insurance and reinsurance industry, serving in executive leadership and board roles during his career. Before joining AIG RE, Chris was the CEO of Victor Insurance Holdings, a division of Marsh & McLennan Companies, which is the largest managing general underwriter in the world. He also served as president of Montpelier Re and was underwriting chairman of Blue Capital, Montpelier's capital markets entity. Most importantly, Chris is a graduate of Johns Hopkins Carey Business School, having earned his MBA here. We're also very fortunate that Chris serves as a member of our Dean's Advisory Council. So welcome, Chris. I'll start us off with a few questions, but we are also very anxious to hear from our audience. And just to remind you, if you haven't been in one of these sessions before, you can submit your own questions using the Zoom Q&A button at the bottom of your screen at any point. So Chris, welcome. Great to be with you.
Thanks, Alex. Great to be here. Thank you.
So I thought it might be very helpful to start talking a little bit about the reinsurance industry. Not everybody is familiar with the difference between insurance and reinsurance. So if you wouldn't mind starting off with explaining the concept of reinsurance and why it's so important for the insurance industry.
Sure. Happy to. Thanks, Alex. I appreciate it. And hi, everybody. Let's start off with the concept of insurance before we get to the concept of reinsurance, because it's all about the insurance industry. Reinsurance is a derivative of the insurance industry overall. So in terms of the insurance industry, first off, let's just make sure we're all clear with what insurance is. It's really protection against financial loss. That's what insurance, in essence, is seeking to do. And when we think about the insurance industry and how that works, it works really by pooling risks together. And it's really the law of large numbers that is actually incorporated into the thought process in terms of how insurance works. The reason the law of large numbers works is because we know that events will take place. We don't necessarily know where they'll take place or when they'll take place, but if you have enough of a premium flow, if you will, coming in, you have the ability to actually pay for those losses wherever they might be. So the law of large numbers itself is core to it. The risks themselves are actually pooled onto balance sheets. So insurance companies have balance sheets that really kind of just report their capital. So they have a capital position, and that capital is therefore used to pay for losses if the losses are actually greater than the premium that they bring in. But either way, they're geared towards their balance sheet capability, and that allows them to execute in a global market. Reinsurance is there to help protect that. So what happens, insurance companies take on risk. And as they take on risk, the premiums and the limits are different. The premiums are much lower, as you know, than the limits that are actually providing you protection. Those limits, however, are liabilities that sit on the balance sheet of an insurance company. And ultimately, what an insurance company will look at is the degree of liabilities that they actually have on their own balance sheet. So the degree of liabilities against their capital position. And in order to try to protect that capital position, they themselves will buy insurance. So when an insurance company actually buys insurance to lay off risk, transfer risk, they buy the insurance from a reinsurer. And that's where the reinsurance community actually steps in and provides the protections to insurance companies. And in essence, it's really a contract between the insurance companies and the reinsurers. And those contracts are basically on an annualized basis, and they can be for varying lines of business. They are for actually varying lines of business. And so The industry itself is a relationship that is established so that risk can be transferred. Reinsurers also have balance sheets. And so as reinsurers take on risk from all of the insurers throughout the world, they also will overload their balance sheets to a degree. Overload is probably the wrong term, but basically they'll have more risk than they really want to hold on to. So reinsurers will also buy insurance. And when reinsurers buy insurance, it's called retrocessional reinsurance. So when we buy insurance, we buy it from another reinsurer. And that reinsurer will also load up their balance sheet to a degree and feel that they may have too much risk against their capital position. They will also buy insurance, and they'll buy retrocessional protection themselves. So it's really a spider web of risk transfer that happens on a global basis. And every insurance company has these structures in place. And it's really there to both protect results on an annualized basis, as well as protect the balance sheet as they're taking risk regularly throughout the calendar year, yes, but really throughout the entire time period that enterprise starts. They really have to, begin to shed risk as they're bringing it on board in order to, very effectively manage the overall risk level of the organization. So that's what reinsurance is, and it's been around for a long period of time. The insurance industry itself has been around for several hundred years. Reinsurance has also been around for several hundred years as well.
Right. Well, a couple of points that you raised. We'll come back and talk a little bit about the balance sheet of reinsurance companies and the capital base. But you talked a lot about pooling and diversification. So I'm curious, when you were selected to lead AIG RE, there had been or was subsequently consolidation of the company's assumed reinsurance operations into one global business. So I'm curious, what were the advantages of this consolidation? Did it go back to sort of your point about pooling, or was it more of an organizational issue?
No, it wasn't about pooling. It was actually an organizational design issue. We have within this organization several companies that knitted together actually perform more efficiently by being engaged as one enterprise. We have companies that have balance sheets. So we don't just have one balance sheet for our operation. We actually have 3 balance sheets that we use for the operation. One of them's here in Bermuda, and there's another one in Switzerland. We have one that we utilize that's actually based in London. And so those are the balance sheets that we actually have. We also have an alternative capital asset manager, so an insurance asset manager. And what an asset manager does in the insurance space is they connect with outside institutions who are investors and work with them to create an opportunity for those investors to invest directly into the insurance industry by providing them a direct route in for risk. So what do I mean by that? So there's an outside investor. You have several ways of getting insurance risk. One way of getting insurance risk is to go buy the stock. Go buy corporate stock on the New York Stock Exchange or London or wherever you want to do it. That's one way to access insurance risk. But you also have capital markets risk. You just have financial institution risk. You have a whole slew of risks by doing that. You also can think of fixed income instruments as another option. You can buy an insurance company if you want, but then you got to operate it. So that's another option if you want to do that. But another way of doing it is actually to engage with an enterprise that has access to the risk. In essence, give them funds for them to actually match up against the insurance risk that they have access to, put it into a fund itself, and seek to generate yield over an annualized basis. So we have an asset manager that actually does that. And so that's part of our overall structure as well. And then we also have a research enterprise. And the research enterprise is a standalone entity that we have a number of PhD individuals and master degree individuals and individuals that are very focused on the sciences, et cetera, that are part of that group. And that's a standalone company. And all that group does, and I say all in a very respectful way, because they're actually assessing risk 24/7, 365. And that's what they do. And that team provides us analytic capabilities for our deployment of capital and our assessment of risk. So by having them separate, that didn't make sense. By bringing them all together, we were actually able to construct a very effective reinsurance business using different sources and forms of capital to access risk as well on a global basis and to analyze it effectively by having the right team and structure in place to do that. So it was a strategic position to bring them all together, created efficiency in doing so, and then allowed us to really focus on what we're trying to accomplish in this industry, which is providing effective protections and also providing effective returns for our investors, whether that's on the balance sheets or whether that's on using alternative capital.
Right. And alternative capital clearly is one of the recent trends in the reinsurance industry. I'm curious where you said that reinsurance has been around for hundreds of years. Where do you see the business headed in the long term, and what are some of the innovations, perhaps technology driven, that could have a significant impact in the industry?
Yeah. Alternative capital is actually, conceptually it's been around for a long period of time, but it really has kind of come into its own really over the last few decades. And as we think about the industry itself, there's absolutely going to be a need for risk transfer. There's certainly a need for continued assessment and analysis of events, whether those are weather-based events, climate change, whether those are man-made oriented situations as well, because we model those too. There's going to be a need for that really kind of across all spectrums. So, as far as where the business is heading in the long term, it's got plenty of runway. And as we all know, the world's changing quite substantially. When we look at climate change, we have a certain perspective on that. We are seeing where events are more frequent to a degree. We are seeing, more extreme circumstances that are happening. And there's a need to really assess that and really focus on how to think that through from a pure risk point of view. So I think there's a tremendous amount of scale and capability that's going to be needed as we continue forward as an enterprise and as an industry itself. As far as innovations that might be out there and kind of what's going on and how to think about that, there's a significant amount of innovation that actually is taking place. And some are good, and some, when you think about impacts associated with that, some are good, some have positive impacts, some have negative impacts. But all it's about progress. So it's all fine either way. It's just as you think about your current business model, there may be some different ways of thinking about those issues. We think about areas for loss impact, for example, the extensiveness of cyber risk that permeates everyone's life is quite substantial. And we provide protection for this sort of risk as an industry. And trying to unpick the likelihood of loss associated with cyber is quite an undertaking. And it's in its earlier stages. But it's one aspect of change and of innovation that actually is happening just in the world that requires us to think through best how to assess the risk and ultimately provide protections for it. So that's one area. Another area is autonomous vehicles. So autonomous vehicles, if you think about it, everybody buys car insurance, right? That's what we buy today. But autonomous vehicles are, getting to the point of development where, they're possibly pretty smart and they can kind of do what they do on a road and you're feeling generally safe. Are they there yet? I think that's for others to decide. But the point is that, autonomous vehicles, those that are part of that whole wave, would look at insurance, for example, and suggest that perhaps insurance isn't necessary because their vehicle is so smart, it's not going to get into an accident, right? So those are some innovations that are out there that have an impact on the industry itself. Alternative capital, you mentioned, alternative capital itself, was a more recent area that was introduced to the industry, and it took a lot to actually make that work. I mean, the insurance industry has been around for 300 years, reinsurance has been around for quite a while, and we still try to perfect it. And then you bring in this new way of kind of thinking about how to apply capital to risk. It actually is also in its stage of development. And using that capital, we actually don't apply it to the level we would like to all of the risks that are available to us. We primarily apply that capital to property-oriented risks, hurricane exposures, that sort of thing, where we can model and semi-predict what's likely to take place in a portfolio. So, but that's another form of innovation that's kind of out there that we integrate into the business and have to constantly think about. I won't really talk too much about cryptocurrencies, but that's another form of capital that technically could be out there that you could, over time, if it did take hold to the extent that, depending on the pundits that you listen to, it could be another form of capital to consider at some stage. Point is that there's definitely innovation that's taking place that is, intriguing and does have an impact on the business. Last one I'd probably suggest is, I'm not sure if anybody on our, in our audience had heard of like InsurTech, but InsurTech is out there. And what that's trying to do is actually create greater efficiencies with regards to the transaction of insurance. But in so doing, it's collecting data that is pretty profound. And the data itself, when researched, throws off information that you would not otherwise think about. And that's the beauty of some of this, is that we find information, you start drilling into it, and there are aha moments that you have as you're moving through this. So again, the innovations are pluses and minuses for the industry, but overall it's progress. And on a net basis, it keeps things very interesting for sure.
Right. Yeah, and maybe we'll come back to the InsurTech, some great examples of technology in your car and other things that are fascinating. So I want to continue sort of with this focusing into the future and digging in a little bit more to some of the risks that you mentioned. But I did want to sort of pause for a second just to talk a little bit about one historical point in time, which was the financial crisis of 2008, which was really significant for many firms, including in the insurance and reinsurance industry. And I'm curious, from your perspective, how did AIG deal with the crisis, specifically from a perspective of understanding more about leadership and maybe leadership lessons that you learned coming out of that period of time?
That's a good question. So AIG is a storied company for sure. It's a terrific firm. And it started in the early 1900s. And for the first 75, 76 years or so of existence, there were two CEOs that actually brought the company to where it was in the early 2000s. There was a bit of change that happened prior to the financial crisis. When the financial crisis took place, there were a number of CEOs that actually were put in place to try to sort some things out within the overall organization. And in fact, between the time of those first two CEOs, who were 76 or so years of running the firm, over the next 12 years or so, there were 5 CEOs. And so as we're moving through the financial crisis, you had CEO after CEO after CEO trying to figure out what best to do. And there were certainly, decisions that had to be made and all of that. And ultimately, they made their way through. AIG itself, fully paid back the government with interest, et cetera. And, really, stood up to the plate and delivered what they said they were going to deliver. So all great. However, the firm still had work that it had to get done once that all kind of took place. And after those 5 CEOs had moved on, there were new individuals that were brought in. And, those new individuals in a very short period of time actually turned the company completely around from where it was. And they brought in individuals that had capabilities that were very, very necessary. and they brought in the right teams, and they brought in the right perspective, and they knew the business, and they knew the industry, and they knew it had to get done, and they had reach, and they had strong leadership skills. And where we are today is with strong leadership within the organization, a very clear understanding with what we want to accomplish, with tremendous capabilities, with a refreshed portfolio, and a new view as to what we can do in a changing environment. And so, to answer your question, I would say that it's very clear that bringing in the right leaders is extremely important. And I've gotten into a debate with people in different ways. Can one person make all the difference? And my opinion, I would say yes. One person, a very strong, capable leader, can make all the difference. And I think those are maybe some of the lessons that I would look at. And I wasn't at AIG at the time of those issues taking place, just to be clear. So this is my perspective looking in.
Yeah.
But in doing that, my view is, frankly, you bring the right leaders in, you can solve massive problems, and you can solve them relatively swiftly. But they need to understand what the issues are and need to know how to go about doing that.
Right.
So.
Great. Thanks, Chris. I appreciate that. Well, I do want to talk about, you've mentioned sort of a variety of different natural catastrophes and environmental and climate change issues. Before we get to some of those, obviously a catastrophe that we're all familiar with is this COVID pandemic, and the losses. These things are obviously hard to estimate, but one estimate of the financial costs of the pandemic, both from lost output as well as health reductions, was estimated at more than 16 trillion. That's a staggering sum, and clearly those aren't all insurable losses. Probably a very small component of that is, but the insurance industry is obviously prepared for catastrophes. That's what you all do, including pandemics. And so I'm curious, how has the insurance and reinsurance industry fared during this crisis?
Well, I think it's worked its way through so far. The crisis is still here. It hasn't changed. It's not as if it's passed. So far, I would say it fared generally okay. That being said, as I mentioned, it's still early days. There's a lot that is still being fleshed out and verified. Many losses still have not yet been fully paid, primarily because they need to be determined the extent of that, what those losses really are. Right. And it's not a reaction of the industry not wanting to pay claims or anything like that. Not at all. It's really what is the payment that's necessary if in fact there should be payment. And when you think about the pandemic, it's differentiated from other events that you would see from a catastrophic nature. So let's use hurricane as an example. Hurricane is an Atlantic Ocean issue primarily, certainly in the Pacific as well, and get out to Asia, it's typhoon and all that. But it's very localized, if you will. Now, Ida, that came through the through the Gulf, and then came up through the northern part of the U.S. So it was more than just a state, but it was a country, if you will. I'm just went into Canada as well. But point being is that that's pretty localized. The pandemic was global, and that's a different circumstance, because when you think about loss and you think about how to consider the compensation associated with that, there are a number of issues that need to be taken into account. Policies are what are issued to individuals who buy insurance, and those policies have different exclusions or coverages embedded within them, and each state can have a different one. Each country can have a different one, and how they play out relative to what was intended to be covered versus what was covered is also an aspect of this. So there are a lot of issues that still need to be vetted through to ultimately determine how will this, play out with the overall global insurance industry. So it's a complicated issue, but I would say that the insurance industry is cognizant of wanting to try to get to the right spot with, their respective policyholders and make sure that, that things are, that it's clear, et cetera. There have been, court cases in different ways for some of this. And so in some of these circumstances, the courts will decide, and that tends to be a little bit more on the business side. But the reality is that each jurisdiction is going to probably have a different nuanced circumstance, and we're still working through all that.
Right. Well, one that I guess an event that we've got a little bit of time, the advantage of perspective of time is September 11 terrorist attacks that we just recently marked the 20th anniversary of. And at the time, it was the largest cumulative claims payout in global insurance history, with insured losses of about $32.5 billion. That dollar amount was then exceeded by Hurricane Katrina after that a few years later. But what was the long-term impact of the 9/11 terrorist attacks on the insurance industry, and has anything changed as a result of that?
Yeah, that's an interesting question. So I was in New York at the time when that took place, and it was definitely a very significant event across multiple perspectives. For the industry itself, it was an event that a number of coverages were triggered as a result of that particular event. There were property coverages that were triggered. There were aviation coverages that were triggered. There were liability coverages that were triggered. There were workers' compensation coverages that were triggered. So it was one of these events that actually brought into play a significant number of areas, meaning lines of business that to some degree were understood, but not to the level that that event caused loss. Now, with all of that, it created also an opportunity for the industry to further evolve. And in some aspects, relative to new companies that were established, the companies actually established themselves. A number of companies established themselves here in Bermuda, which is where I am for those that are guests here. And those companies started themselves up in order to get underway. And Bermuda itself allows you to get underway relatively quickly, which is good. So it established new enterprises here when that event took place. But it also, more importantly, I would say, established a perspective that we need to be able to understand this sort of situation occurring and trying to think through how would you effectively model this kind of event? How would you model terrorism, for example? It's a very difficult risk to model because you don't necessarily know where it may occur, so to speak. And you can actually model and think it through on a deterministic basis, meaning you can think it through from a building to one building to another. And if there was an impact, what would be the impact to that building? You can do that. But when you try to think of it probabilistically, it's very difficult to actually assess it. But it set in motion an ability to try to do that. And the industry was already working on some of this anyway. It wasn't as if, oh, now we should think about, trying to think through, this particular item itself. But it propelled the industry to really try to think it through and really try to consider the varying issues associated with that type of event, which frankly is a man-made event. And many of the modeling that had been done was not really targeted towards man-made events. It was more targeted towards natural catastrophe, where you actually had data and you can understand the number of hurricanes that are supposed to happen in the course of any one year, the magnitude of those hurricanes. And so you can run stochastic models to ultimately get a sense as to what the likelihood of them occurring will be in any one year. And then ultimately, what's the magnitude of loss that would take place against wherever they hit. So it actually propelled that thinking further and allowed the industry to further progress. And so those are some of the issues I think that that did occur. They're probably slow. We probably spend 4 hours talking about that particular event and what it actually did with regards to the industry and some of the things that it caused, both pluses and minuses. But once again, I view it, it's the industry continues to try to learn. It continues to try to figure out how do we assess the future? How do we assess what possibilities could happen? And then how do we get comfortable with that assessment? So.
Right. Yeah, very interesting distinction between the natural disasters and man-made disasters. Let's go back to natural disasters for a second. You mentioned Hurricane Ida and sort of global hurricanes, typhoons. We've also seen obviously a lot of wildfires, floods, and experts are saying that the climate changes worldwide are driving all this. So, or at least increasing the likelihood. So how does the insurance and reinsurance industry sort of engage in these areas to analyze risk in order to provide protection on a global scale? And how do you deal with the fact that the models may be calibrated on data which may be less relevant based on climate change going forward?
Yeah, for sure. Yeah, no, absolutely. Yeah, the models certainly are calibrated based off of events that have taken place. Then they're also run with the perspective of what could happen. So there certainly is more to it than just purely looking in the rearview mirror. That being said, when you see significant changes taking place, you have to decide whether or not those changes are because they're circumstantial, or there's a fundamental issue or there are fundamental issues taking place. And when you consider both of those aspects, when you reach the point of saying more than just circumstance, then you need to bring in further data and further areas of study that are trying to figure out really how all the parts fit, and also what the likelihood of change from those parts altering will occur in the future, right? And so you're definitely looking forward, and then you're literally trying to model out the forward situation, and then kind of scale that back and bring that back to the present state. So it is all prediction, and one of the things with insurance is, for us, no matter how much work we do not know what our costs of goods sold are when we start, whenever we put a policy out. So insurance doesn't know that. Reinsurance, we do all of the work, we do all the assessment. We do not know what that number actually is. It'll take minimum of a year. It can take years for us to understand literally how accurate were we. So we're doing and by using that though, we're actually do some hindcasting and understand what that might mean. But then we also utilize that along with additional information to try to forecast the future. And models give you a direction. We're trying to create models that are directionally correct. No model is perfect. And you try to create models that are directionally correct, that give you a strong understanding of the risk. And then you can make effective decisions off of that, but you're constantly learning. Yeah. And when we recalibrate models, we try to do that as frequently as we can, but you can only recalibrate when you truly have a better understanding as to what you really should be doing in the recalibration, because you can recalibrate and it can get wrong on both sides. And that's not a good business decision, frankly. So we're careful when we do it, but we use both current, former, and forward information in order to incorporate and ultimately seek to predict what may take place.
Great. Well, I encourage everybody to submit questions, and we started to get a couple, and there's one that I'd like to insert here right now because I think it's relevant to our discussion about natural disasters. So here's a question. By the way, it starts off with "very interesting talk!" ! The National Flood Insurance Program has been criticized because it makes it cheaper through subsidies to take actions that may be undesirable in the long run, like building more in flood-prone areas. In terms of policy, How do you see the role of insurance in balancing providing protection and encouraging risky behavior?
That's a good question.
It is a good question.
I'm going to stay out of the politics with all of that, and the policies in and of themselves, the governmental policies associated with all of that. But I think it's a proper question, and the reason I think it's a proper question is that when it comes to risk, you need to make sure that you're up to date, and you need to very specifically think about how you're going to price that risk in being up to date. So, for example, if you have old flood maps and you're basing decisions as to where the floods will likely be based off of old, outdated flood maps, you're going to have wrong selection as a result. Additionally, if you base your pricing off of outdated loss history or miscalculated forward thinking about potential climate change, et cetera, you also have an issue because you're mispricing the risk itself. So you have to be very careful how to think through these particular issues. And when we look at flood maps, they get updated every so often. And it's better now, but they get updated every so often. And when you look at the cost of flood protection, for sure there's more work to be done there. If you're buying in a flood area, you have to get a mortgage, and the mortgage company will require that you buy flood insurance. And if you're buying cheap flood insurance, it does propel individuals to kind of be in that particular area. On the other hand, if actually the actual cost of the flood insurance was, and I'm not saying they're not, there's some that are, there's some that are all actuarially sound, then that's a different business proposition. And that's a different business decision, or personal decision, I should say, as well, that is made relative to that particular cost and whether you're willing to take that cost on and or take that risk. So I think the lack of having updated information can actually cause inappropriate decisions to take place. And I think that investing in that and making that an important priority, I think, would be a benefit.
Great. Thanks, Chris. And you mentioned earlier cyber risk as obviously a risk that has emerged to be a pretty big deal. We're seeing more firms and government agencies falling prey to these cyber attacks. And really the loss of data, the ability to operate, and obviously the ransomware and so on could be really incredibly high. And not surprisingly, we're seeing cyber insurance rates skyrocketing. So I'm just kind of curious if you want to say a little bit more about your take on any trends that you see in this part of the industry, and why is cyber risk and the losses so hard to assess?
Yeah. Yes, we do. We see increases in cyber events. Absolutely, we see it. And now it's a bit of an industry now, right? And so it's certainly on the rise. Countering that is the fact that there are firms that are solely focused on providing insurance protection for this particular area. Now, the issue with cyber attack is that it's a systemic issue. And frankly, it can be an existential issue. If you get it wrong and you have too much of that risk on your books, on your balance sheet as an insurer, you can have significant problems. So everyone in the whole industry is trying to balance off the level of risk that they're willing to take, and also the level of risk they feel that they need to transfer. And that's rippling literally through the industry. And if you think back in time, when is the last technological change that actually had the potential to spawn an entire business line and business areas, new companies that are just focused on one particular line of business because of technology? The last time that probably happened was when the automobile began to be developed and actually became more of an institution as opposed to just a side, whim. And cyber is another kind of technological change that's out there that has the ability to actually create singular line of business in this industry and companies that are focused solely on trying to unpick that. So it's getting the attention it needs, and that's really important. In assessing it, you need to assess, there are a number of different issues that you really need to assess. You need to think about frequency, you need to think about severity, you need to think about how systems can get impacted. You need to think about the size of the company when you're providing insurance. You need to think about the size of the company that you're providing the protection to. You need to run kind of background assessment, on the entities to see, do they have proper systems in place, security walls, et cetera, firewalls, et cetera, so that there can be a muted attack if in fact it was to occur. But all of that is helpful to try to figure out, is this an enterprise that actually takes it seriously? In the end, for sure, there are going to be enterprises that are out there that are going to try to be more enterprising and to try to get in and kind of do their thing. So we think about it from an industry point of view, that when you think about coverages that are out there, you have to think about affirmative versus non-affirmative coverages. So when you have coverages that are silent relative to what they're going to protect, that could be problematic. So what the industry's tried to do is they've tried to say, this is exactly what is covered, and not to leave it gray. Because when you leave it gray as an industry, it hurts both sides. Because one side thinks they're going to get protection, the other side says, no, there's no protection, right? And then you're kind of in this circle that you don't want to be in. So the industry has sought to try to figure out how best to provide coverage that they're comfortable providing, make sure they're very clear on that coverage. And in being clear on the coverage, they have an opportunity to actually effectively model it and price it so that the proper assessment of risk is taking place. Over time, they'll add to some of those that they're covering today, they'll add more to what they're covering today. And it's going to be an evolution, to actually offer a full-blown cyber product that covers everything, doesn't matter where it comes from. That would be a significant problem, frankly. So the industry is trying to tackle the issue, but they're trying to tackle it on a more level-headed basis, if you will, to make sure that they're providing protections that are good protections, can be measured, can be properly priced, and can be ongoing. So it's not just we're going to give it this year, we're not going to give it to you next year. So, because that also matters for a business. Continuity matters too.
Right. Well, you've been talking about pricing here, and we've actually got a couple interesting questions related to pricing in the industry. The first one I'll call sort of the winner's curse question. It says, years ago, studies of oil lease bids found that the winning bid was much higher than the second or third bids. The winner, in a sense, overpaid. Does something similar happen as insurance compete for policies? Is there a tendency to offer coverage at too low a policy premium?
Yes. Yes, there is. For sure. Yeah, absolutely. Yeah. And that's one of the issues that the industry is constantly, trying to figure out, as I mentioned before, we don't really know the cost of goods sold when we actually put it out. And so we're trying to assess risk. And it's, there are nuanced approaches as you think through risk. There's only so much that wording within a policy, on a general policy, can actually be very effective and exact towards. And so these gray areas is where the industry can, misstep. And, frankly, the industry in many ways, when there's I'll just say a dispute, the person who purchased the coverage, is more apt to actually get a judgment for them as a result, because the gray areas, just from a business point of view, it just doesn't work in terms of, when you're in a dispute, it's not going to go to you sold a product that was unclear. That's your fault. So therefore you're going to need to pay. So, but it's something that we're constantly trying to get better at. So yes, the answer to that question is definitely it happens.
Well, and sort of a related pricing question is about soft markets and hard markets. So the question is, how is the transition from a soft market to a hard market affecting reinsurance? And just to put it in context, and you can correct me if I'm wrong about that, but insurance market, this is really about insurance market cycles. And so soft market is when you have increased competition and perhaps depressed premiums. And then that's often followed by a hard market where you have a period of rising premiums and decreased capacity. So again, the question is, how is the transition from a soft market to a hard market affecting reinsurance in particular?
Okay, it's a good question. So first off, so everyone's clear, like hard markets and soft markets, they don't happen like one year to the next. You can go through years of soft market until something occurs and it creates a hard market, right? So, and we can use 9/11 to a degree as an example of that. And the industry back then, was very significant soft market, very significant in the 90s, very significant soft market. When 9/11 actually happened, the industry itself had been losing money for a long period of time. And when that took place, the industry finally said, enough is enough. We actually have to increase the price of insurance. And ultimately that translated into reinsurance prices being more significant as well. Transitioning from a soft market to a hard market, or hardening market maybe is one way to look at it too, because there are times where the market does shift immediately and it is a hard market. 9/11 is an example of that. When Katrina came in, that happened as well. And there were different reasons for it. It wasn't just loss, it was also model reconfiguration, et cetera, and also rating agencies thinking of things a bit differently. So there are times where it really is a hard market and you're there. And then there are times where you're going to a hard market and you're getting there and you're not there yet. And at a certain point, you'll hit the apex plateau, so to speak, and then begin to come down. We're more in that circumstance right now, that it's been more of a move up. So, transitioning from a soft market to a hard market, you do start looking at what are your options. When you're in a really soft market, you're really just trying to play a lot of defense. When you move into a harder market, as a reinsurer, you're trying to think through, how do we play more offense? How do we offer our capabilities actually to the insurance industry and try to scale the business to the level that we can? And that takes actually a very informed approach either way. When you're in just immediate hard market, what that'll do for you is it can hide a lot of sins. And what I mean by that is, we talked a little bit about how we don't really know the cost of goods sold for ourselves. So when a hard market happens, you can just pop right up there and you might not necessarily know if that's the right price or not, but it's much, much better than where it was. And if you actually did get more than it actually was worth, then you're going to be a winner and all that. Now, you have a sense to know that it actually is in decent shape at that level. So you have a sense for it. You may not know absolutely, but you have a sense for it. When you're in a market that's moving in this direction, you actually need to think about, how do we best go about utilizing our capital most efficiently, most effectively, offering that to our clients, talking to them about what they're trying to accomplish, and actually construct a portfolio that is very capable of not only withstanding loss as you're moving into a hardened market, because losses will still occur, but also be there for a long-term basis. As a reinsurer, we don't try to go in and go out. We actually try to construct relationships with clients that are more long-term. On some risks, we will go in and out, but generally we try to create more of a long-term approach. So, where we are right now, it's more that way. So, to answer the question, I think it kind of depends on what kind of hard market you actually have, and also whether that hard market is multi-lined or whether it's more single-lined. So what I mean by that is, you could have a hard market where in the property sector, it is just very, very high priced because of an event that occurred. Right. But in some of the other lines of business, it's still not necessarily soft, but it's not as hard as that market itself. Yeah. Right now, for pretty much all lines of business, we're kind of in this move up across the spectrum of insurance into reinsurance.
Right. Yeah, that's very helpful. Let me switch gears just a little bit as we're coming up to the hour. It's always great when we have a senior business leader like yourself to try to provide some career advice.
Hmm.
And so I'm curious, sort of what advice you may have for our students, or maybe some of our alumni as well, who are interested in risk management and getting in the industry.
Yeah, thanks. Yeah. First off, I mean, it's a fascinating field. I hope some of the dialogue today has people thinking a little bit about the magnitude of what we do. I mean, it's immense. It's ever changing. It's not figured out, and yet we have an entire industry that operates despite some of those issues. And so it's an ongoing challenge to constantly think through: are we handling risk effectively? Are we providing the right capabilities, not just to our clients, but also to our staff to continue to progress themselves? The individuals that we hire in the reinsurance space in our company, I think I mentioned we have PhDs, we have master degree individuals, we have individuals that focus on the geosciences, we have individuals that are focused on physics. We have individuals that have economic backgrounds. We have individuals that have accounting and finance backgrounds. So there are so many mathematical backgrounds for sure. Actuaries, as you know, like this, so it is a very diverse set of individuals that actually come together to try to think through risk. And we also have technologists, because as the assessment of risk is taking place, we actually have to download that assessment across our platforms so that our underwriting staff actually has the most relevant information to price risk as well. So whether it's technologists or scientists or mathematicians or more kind of business background people that have finance or accounting and economics, et cetera, that's the breadth of what we have here, and it's fascinating, and people are very much into it. And you're trying to figure out not just the future, but you're figuring out all these issues. We try to think through space risk, for example. We try to think through aviation risk. We try to figure out avionics and try to determine if losses are occurring or not. Is it because of avionics? Is it luck? What might it be? So we try to think through these varying issues. Talked about cyber a little bit, trying to think through cyber and all the permutations of how a cyber event could occur. And what do we need to do to think about that? So it's an absolutely fascinating field. And I would, as a minimum, ask individuals who are thinking about what their career might be, just go take a look. Have a conversation with someone who's involved in the industry. I'm happy to actually have a conversation with anybody. It's fascinating. We really need intelligent people. We need capable people. We need driven people. We need individuals that have very significant skills. And there's a real career here for individuals that are thinking in that vein. So that perhaps is how I would consider this for individuals that are thinking about what they want to do. But I'm happy to talk to anybody about it. Again, I'd ask them just to give it a shot. Take a look, give it a shot, have a conversation about what this industry actually has.
And while we're talking about talent, I want to bring up an issue that's very much on the minds of a lot of senior business leaders, such as yourself, which is diversity, equity, inclusion, and belonging. And I actually started my day with a 3-hour discussion this morning on DEIB with deans from literally around the globe. And so I think of AIG as, I think, having representation of like 80 plus countries. And so I'm curious how you all have discussions or initiatives about DEIB within the organization, given that global footprint, and how do you ensure that your talent is coming from underrepresented groups as well?
Yes. Yeah, it is a very important issue for this company throughout the entire organization. And the reason it's important is that it really does enhance the overall team dynamic as you're thinking about issues. You're bringing different perspectives to the table. And those perspectives matter. And as I mentioned, we'd love to know our cost of goods sold right up front, right? And so the more information or knowledge or understanding that we actually have as a group actually helps us quite a bit. With all that, from a point of view as to what we're trying to do with that, there absolutely is very significant just programs and training, et cetera, that for everybody just to understand the issues, because not everybody understands all the items that are associated with this particular important area. And there's real value in people understanding. And in order to allow people to understand, we do bring teams of people together who do come from varying backgrounds, and there are discussions that take place and moving down a particular path of knowledge. And so, the organization, definitely has that as part of it. They have, certainly put in place certain perspectives and actions to make sure that the individuals that are being brought in are diverse. And so there's very specific activity that's taking place to make sure that we're absolutely doing that. So that's been an important aspect of just what the company has established in terms of its hiring practices and what it's trying to reach globally to do. We kind of have a benefit in the sense that, we are in so many different countries. So we actually have a benefit of being able to engage with varying cultures, varying races, you name it, religions, et cetera. I mean, it doesn't really matter. We have, this very significant footprint, and it actually helps us to grow as an organization by having that capability. So it's not just education and also instituting specific practices within the organization. It's also making sure that as people are coming in, that we're also providing them training and for leadership development too. That's another aspect that's very, very important. It's one thing to bring individuals in, provide them knowledge and capability relative to the industry. It's another thing to then begin to train them as leaders so that as they go out, they're also bringing in individuals or talking about this enterprise very proactively and talking about the company as being an organization that's seeking to try to create real opportunity across the board for individuals. So it's a really important aspect of what we do.
Great. Well, thanks, Chris, for those insights. And you mentioned that you're in Bermuda, and we can actually see a gorgeous blue sky, and that's even with a screen in front of it, and even the clouds look very nice. So I know it's getting late in the afternoon there and here, and I want to let you go, but I just want to thank you so much for being with us over this past hour, for being such a great supporter of Carey Business School, and thanks so much for taking the time to do this.
Thanks, Alex. It's been a real pleasure. Real pleasure. I look forward
I also want to
talking to you soon. Sorry.
Thanks so much, Chris. And I also wanted just to say a quick thanks to the audience for joining us and for those great questions that were submitted. Sorry that we couldn't get to all of them. We also hope to see you all again for our next event, which is going to be on October 4th. It'll be featuring Rob Davis, who is the new CEO of Merck. This particular presentation will be part of the university's health policy forum as well. So hope to see you all there. Thanks again, Chris, and everybody have a great evening.
Great.
Take care.
Thank you, Alex. Thank you, everyone. Take care.